A major Canadian oil producer has completed a full exit from U.S. shale operations, selling its entire Eagle Ford position in Texas in a multi-billion-dollar transaction. The move is drawing attention not just for its size, but because analysts say it reflects a broader structural shift.
The move is drawing attention not just for its size, but because analysts say it reflects a broader structural shift in how energy capital is being deployed across the United States and Canada.
Here is what has happened, why it matters, and what it could mean for energy security and regional economies.
In late 2025, Baytex Energy confirmed the sale of its Eagle Ford shale assets in South Texas for approximately $2.3 billion US. The deal closed in December and marks a complete withdrawal from U.S. upstream production for the company.
Just over 2 years earlier, the company had spent roughly $2.5 billion acquiring Ranger Oil to expand its presence in the same region. The result is a clear financial loss on the transaction, even before accounting for operating and integration costs. The assets were not marginal, producing around 83,000 barrels of oil equivalent per day, accounting for roughly 44% of the company's total output. Energy analytics firm Enverus estimates that the sale removes nearly 2/3 of Baytex's enterprise value, underlining the scale of the strategic shift. The buyer has not been publicly disclosed.
Industry analysts believe the assets were acquired by a financial or private equity-backed operator, rather than another major producer. That detail matters. Analysts point to three main drivers behind the decision. First, shale economics. U.S. shale production relies on continuous drilling to offset steep decline rates. Wells in plays such as Eagle Ford often lose most of their output within the first year, requiring constant capital investment to maintain production.
By contrast, Baytex's Canadian assets, particularly in Alberta, offer lower decline rates and stronger return, with less ongoing capital intensity.
Company guidance shows internal rates of return in Canada exceeding 50% at current prices, considered exceptional within the sector.
Second, maturity of U.S. shale. U.S. crude production has largely plateaued at around 13 million barrels per day. Much of the most productive acreage has already been developed, leaving operators to drill less efficient locations at higher cost. That has reduced the appeal of further expansion for producers with alternative options. Third, the rise of financial buyers.
Private equity firms are increasingly purchasing mature producing assets with limited drilling inventories.
Their model focuses on near-term cash flow rather than long-term resource development. And according to Enverus, private capital accounted for roughly 35% of upstream oil and gas transactions in North America in 2025, up sharply from 5 years earlier. And for communities across South Texas, the change in ownership is raising concerns.
Financial operators typically run leaner operations and invest less in new drilling.
That can mean job reductions, fewer service contracts, and pressure on local businesses that depend on steady reinvestment. While production is continuing for now, analysts say reinvestment levels will determine how long output and employment remains stable. The development also has cross-border implications.
Canada remains the largest foreign supplier of crude oil to the United States, providing more than 60% of U.S. crude imports. Many U.S. refineries, particularly in the Midwest and along the Gulf Coast, are specifically configured to process crude imports. Many U.S. refineries, particularly in the Midwest and along the Gulf Coast, are specifically configured to process Canadian heavy crude. Analysts warn that increased concentration of ownership among financial buyers, with Canadian producers prioritizing domestic and export-oriented infrastructure, could introduce long-term supply uncertainty.
Canada has recently expanded export capacity through the Trans Mountain Pipeline and an LNG project on the Pacific Coast, giving producers greater access to global markets. And Verus analyst Drew Dowd describes the sale as part of a wider transition, reflecting how U.S. shale has entered a more mature phase rate, attracting capital focused on extraction rather than growth. A 2025 study by the Kansas City Federal Reserve reached a similar conclusion, noting that U.S. refiners cannot easily replace Canadian crude due to infrastructure and refinery constraints. And this is not a short-term disruption.
Production is continuing, workers remain in place for now, and supply chains are functioning. But the direction of capital is changing. Canadian producers are consolidating closer to home. Financial firms are taking a larger role in U.S.Gas, and North American energy markets are evolving quietly, without dramatic headlines. For policymakers, refiners, and regional economies, the long-term consequence will depend on how investment, regulation, and cross-border cooperation adapt to this shift.
Clarvex News will continue to follow these developments.